In this video, we examine the fundamental reports a bit closer. These have been significantly updated recently and now contain much more detailed information. You can consult them on the profile page of the company in question via the item Fundamental Analysis. These reports are generated using figures from the company's quarterly and annual results, which can be found on the profile page under the Financials tab. Based on this data, ChartMill offers more than 85 fundamental ratios, which can be used as individual screening filters. The fundamental analysis reports highlighted in this video are also created entirely autonomously on the basis of this quantitative data. They provide an objective and in-depth view of the company's specific fundamental strengths and weaknesses, divided into 5 main categories: profitability, valuation, financial health, growth, and the dividend policy. An overall fundamental rating score is then displayed based on these individual scores. For both the individual components and the overall rating, the score ranges from 1 to 10. The higher the score, the better. These reports are ideal for a quick check of the company's strengths and weaknesses. The 5 basic categories retained are easy to understand even by investors who have less experience with fundamental analysis and its specific ratios. However, the report also takes a deeper look at the ratios that matter and compares them on a sector and industry level. This way, you can quickly find out how strong or weak a company is performing compared to its direct competitors. The fundamental charts that are part of the report reveal in a single look the evolution of one or more ratios over several years. Now, let us briefly go over the various components separately. The overall fundamental score is shown on the left. This is a final score based on the various individual components. The pie chart immediately shows in which the company scores strong, average, or rather weak. By moving the mouse over the pie chart, you can see the individual scores for each component. At the bottom, there are quick links that take you to the desired component immediately. The 5 basic components are shown on the right, and we'll start with the profitability section, which is broken into the basic checks, where you can see the evolution of net income, EBIT, as well as the operating and free cash flow, and then some ratios. The ratios that play a role in interpreting profitability being the return on assets, return on equity, and the return on invested capital. These measure how effectively a company uses its assets to generate profits. The report shows not only the current figure, but also the average over 3 and 5 years. And finally, the fundamental chart shows how these ratios have evolved since 2014. It then looks at gross, operating, and the profit margin. These measure how much profit the company generates on its sales. And for the gross margin, this is after payment of costs of goods sold. For the operating margin, other operating expenses, before interest and taxes, are also taken into account. And finally, for the profit margin, interest and taxes are also taken into account. Again, for the different margins, the average over 3 and 5 years are shown, and you can see their evolution since 2014. The second section is health, which looks at the extent to which a company is financially healthy or not. Again, it starts with some basic checks. Among other things, the evolution of the number of outstanding shares is examined. Furthermore, the total debt over a year is compared with total assets. Next, the solvency is examined. This assesses a company's ability to meet its long-term financial obligations and continue its operations. To assess this, specific ratios such as the debt to equity and the debt to the free cash flow are used. Finally, liquidity is addressed. This looks at whether the company is able to meet its short-term financial obligations with available short-term assets, like the cash position and inventories. The ratios used for this purpose are the quick and current ratio. The current ratio is more conservative in the sense that available inventories are not taken into account for the current assets. For the third section, growth, a distinction is made between the past and the future. Both the earnings per share and revenue growth ratios are covered in this section. For both ratios, the performance of the past 5 and 3 years is considered, as well as the past year. Also, the quarter-to-quarter performance is considered. ChartMill also offers analyst estimates at 1, 3 and 5 years in terms of expected revenue and earnings growth, so you can find these here as well. Both graphs show current revenue and earnings per share relative to the outlook, thus providing insight into the evolution of the growth rate. The fourth section gives more detailed info on how cheap or expensive a stock is. In other words, it provides information about how the stock is valued. The first section considers the price to earnings ratio and the estimated price to earnings ratio. A number of price multiples are also considered, being the price to the free cash flow and the enterprise value to the EBITDA. Furthermore, growth is also considered. The price to earnings growth ratio is used for this purpose. Compared to the ordinary price to earnings ratio, the expected growth is also taken into account. And in this way, it is sometimes justified to buy companies with a somewhat higher price to earnings ratio. The fifth and final section looks at the dividend policy. It looks primarily at the dividend yield and how it compares to sector and industry peers. The dividend is also compared to the average dividend yield within the S&P 500. Furthermore, it looks at how dividend growth is evolving and how many years the dividend has been paid continuously. Finally, to assess reliability, the number of consecutive years the dividend has not been reduced is also examined. To what extent is the dividend paid sustainable in the longer term? There is little point in choosing stocks with a very high dividend if there is a high probability that the dividend cannot be maintained. To avoid this to some extent, we consider specifically the payout ratio, which tells us what percentage of earnings is used to pay the dividend. The less of the profit has to be used to pay out a dividend, the better. High payout ratios of more than 75 or even 80% can only be justified in very large mature companies that generate a lot of cash and where the possibilities for further growth are rather limited. Under each of these 5 components, you will find additional information about the ratios used. Very helpful also is the shortcut to industry peers who also score well for this specific component. And which component you focus more or less on depends largely on your strategy. A quality investor will pay particular attention to the profitability component. This investor is willing to pay a premium for really good quality stocks. However, the valuation component will still be considered to avoid extremely expensive stocks. And whether the company pays a dividend is less important. After all, if the yield is high, it is much more lucrative for the profits to be reinvested in the company itself. The value investor will focus primarily on the valuation aspect. After all, he or she wants to buy shares that quote as low as possible below the intrinsic value. That way, they build in a large margin of safety, and attention will also be paid to the dividend. Those who are mainly interested in growth stocks will rather focus on the specific growth parameters. This type of investor is looking for stocks that are growing at a high rate and, hopefully, will generate a lot of profits at a later stage. The focus on current profitability, as for the quality investors, is less important, as is the dividend. Any profits should be invested primarily in further exponential growth. The focus on financial health of a company is the parameter common to the different strategies, and even as a pure technical investor, you could take this into account to at least exclude companies that could quickly get into trouble because of a thorny financial situation. The great advantage of these fundamental reports is that they give context in a highly visual way to the various parameters that are important for each individual component. This makes it accessible even to those less familiar with fundamental analysis. For the seasoned fundamental analyst, this can be a starting point as a first quick interpretation. Moreover, the many filter options on the stock screener page offers a range of possibilities to zoom in even more on specific details. Do you have specific questions or comments about our fundamental reports? Be sure to leave your comments below in the comments section or contact us via the website. Thanks so much for watching the video. Be sure to give us a like and I'll see you next time.